Hello traders, and welcome to lesson number 4 in the ReadFX Beginners Forex Trading course. In this video, we're going to answer the question, what is the spread? So the difference between the bid and ask prices is called the bid-ask spread, or the spread for short. Now the spread goes to your broker and it's a cost of trading. Spreads differ enormously from broker to broker and even by account type, so it's important that you shop around to get a good deal. So let's have a closer look at the spread. Now, in our previous video, we used eBay as an example, and I'm going to use the same slides again because it illustrates it very well. Let's just imagine that we have a seller on eBay selling this TV and he has an asking price of $100. A buyer comes along and makes a bid of $99, okay? So the difference between the two is $1. So we have a bid of 99, our seller asking 100, the difference is 1, and this is the spread. Very simply, it's just the difference between the bid and the ask. But what makes the bid and ask prices actually move and therefore makes the spread change? Well, in a marketplace, people are always buying and selling, which means that the orders available in that market are always changing. If we have a look at the order book here on the right hand side, we can see a list of bids. These are the prices that buyers are willing to pay, and we can also see a list of sellers and the prices that they want to sell their TVs on eBay for. And as a result, these prices will keep changing. So if a buyer comes along right now, sees this price of $100 and says, yeah, I'm going to pay that, and clicks this button, this order is going to be removed. This telly will no longer be for sale because a buyer just came along and bought it. So let's see the effect that has on the spread. So now we can see after our buyer clicked the button that our $100 TV is now gone. The next best available price is $101. Okay, so a new seller is now selling his TV, and that is the best price available, so it now appears here. The buyer who set the bid of $99 did not buy the TV for $100. He still is sticking to his guns at $99, and therefore the spread has now increased from $1 to $2 because a trade has happened. Now trades are happening all of the time, hundreds if not thousands of times a second. New people come in and place bids, and new sellers come in and set different ask prices, and therefore the spread never stops moving. Now you might be wondering, what happens if the spread gets too big because nobody wants to buy or sell? Well, in that case, we have market makers. So market makers, also known as liquidity providers or LPs, are legally bound to be buyers and sellers of last resort. So they must buy and sell. Even if they don't want to, it's their job to make the market. But if they have to buy or sell, it will be at a price that they want, not a price that you want. Let's recap what we've learned then. So we now know what the spread is and we know how it changes. In the next lesson, we're going to look at pips and points.